Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our February 2019 IFRS Insurance Webcast. The title of today's webcast is The IASB Completes Its Third Round of IFRS 17 Amendments. IFRS 17 scope is trimmed for banks and transition for claims liability simplified. The agenda for today is structured, as always, around three items. First, I will give you the highlights of the IASB meeting, which was held on the 7th of February 2019. Then we'll spend the lion's share of today's webcast talking about the discussion the IASB took to reach their various decisions and why those decisions were reached the way they did. And then finally, a few minutes at the end, where I'm going to tell you what are the next steps following the board meeting on the 7th. Coming straight into the highlights, this is now the third session dealing with the 25 concerns that the IASB identified in their October 2018 meeting. That is also the meeting when the IASB approved unanimously the criteria for assessing each and every one of these 25 concerns. So we got now to the point of having effectively decisions on 24 out of the 25. The papers covered about 4 concerns from a brand new perspective, plus there were others coming back for a reassessment or a connected assessment. 2 of these concerns have resulted in approved amendments to IFRS 17. The first amendment is the trimming of the scope of IFRS 17. So what the IASB has decided is to amend the scope of IFRS 17 and IFRS 9 such that insurance contracts for which the only insurance risk in the contract is from the settlement of some or all of the obligations created by the contract, they could be designated to be accounted for under IFRS 9. We're talking about effectively loans with a significant insurance risk being part of the terms and conditions. The second amendment that has been approved is on transition, where the IASB has now approved a new modification for the modified retrospective approach, and that is to simplify the transition for liability for incurred claims that were acquired by the insurer prior to the transition to IFRS 17. And the simplification is effectively to allow them to avoid the computation of a CSM and to turn them into a liability for remaining coverage. The one remaining concern that is of substantial material impact on this particular phase of the IFRS 17 history is concern number 2, level of aggregation. That's the one that is now being reserved as the last one. Very material topic, of course. We'll see whether the IASB is going to reserve a surprise for us. A surprise for me would be an opinion different from what was already articulated in the October paper from the staff, which was a preliminary conclusion that this concern doesn't offer a possibility for an amendment that would pass the criteria. But we'll see in March when this is brought back for discussion what is going to be the gist of the discussion. There are also other sweep issues coming back, including some issues around the risk mitigation option for general model contracts and the possibility to solve the alleged concern through a prospective application of these accounting hedging. So that's the highlight. Let's begin then with the first of the amendment that were approved, the one on the scope. This was concern number 1 in the list in October, if you want to trace it back to your notes. And it does apply to certain forms of insurance contracts. As you know, insurance contracts are defined in the standard and they should be subject to the accounting of the standard irrespective of the nature of the entity that issues them. And so whether you are a regulated insurance company or not, if you issue a transaction that meets the definition of IFRS 17, you should account for that contract under 17, unless you are caught by one of the several scope exemptions which are currently part of IFRS 17. The other important point to bear in mind here is that IFRS 17 has changed the unbundling regime from what IFRS 4 has. And whilst in IFRS 4 you have an option to elect the unbundling of non-insurance components if you decide that this is your policy, that policy choice is gone. Unbundling is a matter of judgment, but it provides only two possible answers. Either you are required to do it or you are prohibited. So that means that when the non-insurance component is non-distinct, you must not separate it from the insurance component, and you should account for the whole contract in IFRS 17. So that means that for these loans or other forms of credit that transfer insurance risk, if there are non-distinct financial elements in it, then the whole contract is IFRS 17. And that's where the concerns have been brought to the attention of the IASB, because some stakeholders have noticed that IFRS 17 would impose to a number of entities that effectively sell only this type of insurance contracts as defined in IFRS 17, and we would require them to adopt IFRS 17 in their entirety. Examples of such contracts are mortgage with debt waivers, lifetime mortgage contract, student loan contracts where repayments are income contingent, and others, all fall within these categories. As you can see, in all these instances, the repayment of the loan is subject to an uncertain future event that may adversely affect the policyholder/borrower. And if it happens, then the lender/insurer would effectively accept to have a reduced or no settlement at all from the element of the contract that has been created by the lending activity of the cash in the first place. Stakeholders who have brought this concern have also highlighted that they feel that the cost that issuers of these contracts would have to incur to comply with IFRS 17, they would not overcome the benefits. There will be actually, there will not be smaller than the benefits that they're going to receive from compliance with IFRS 17. And they also argue that IFRS 9 could potentially offer an equally valid and informative accounting basis for those contracts. And so you can see that from the blue box, the staff of the IASB proposed an amendment to IFRS 17. They acknowledge that there may be significant cost to implement IFRS 17 for these type of contracts, and for a number of entities that would be in that particular situation, potentially limited benefits coming from compliance, because a number of these entities only issue these type of insurance contracts. So IFRS 9 could be an equally valid solution that may provide useful information to the users of the financial statements of those entities. On the grounds that they were actually arguing for an amendment, the staff informed the IASB that they had considered a number of alternatives. Approach one was to effectively change the unbundling requirements and to make it work also for these type of contracts, effectively separating the loan from the insurance contract host. Two variances for the second approach, which is effectively a scope solution. The first one is to make this contract something which is out of the scope of IFRS 17. The second one, which is the one that the staff actually favored, is to introduce an option similar to what IFRS 17 already has for fixed fee service contracts, where you can designate them and then decide whether you want to account for them under IFRS 17, in which case you keep them in the scope of the standard, or designated to be accounted into IFRS 15, in which case you put them out of the standard. Another example of a similar exclusion by designation is financial guarantee contracts. So they are effectively applying the same techniques for this one. They also noted that amending the IFRS 17 along these lines would permit an entity to apply either IFRS 17 or IFRS 9, depending on the specific population that they happen to have in their financial statements. These would also avoid any undue impairment of the comparability, given the analysis the staff has done as to the distribution of these type of contracts across preparers. And it provides the staff with arguments that would indicate all criteria are passed, and for the amendment along the line, the approach 2B is the one that is recommended. The staff also highlighted that there will be other matters depending on this decision on transition and disclosure, but they're going to be taken to the board in March as part of the sweep issue session. And so the recommendation was voted with a very large majority of 13 votes against 1 in favor of the introduction of this new narrow scope amendment. Then let's move into the set of papers that actually talked about other proposed concerns and amendments, but none of which have been approved. And most of them actually about transition. So the first one is transition from an optionality perspective. One of the things that we should remember is that IFRS 17 requires the retrospective restatement of prior periods up to the point where it is impracticable. When it is impracticable, then there is a flurry of options available. And in particular, the insurer will be able to choose between the fair value approach or the modified retrospective approach, a combination thereof, combination which may be made only by effectively choosing that restatement on a group-by-group basis. But the investors community, the stakeholders that come from that particular group, have expressed a concern that this optionality appears to be far too wide, and their concern is that with so many different options, there is a risk of reduced comparability on the performance of insurance companies after the transition date. And potentially that reduced comparability may last for several years to come. That could also disrupt the building up of trend information for a number of insurance contracts. And so they were concerned about that and suggested that perhaps the board should remove optionality. The IASB staff was not of the view that this would actually pass the criteria, and they explained that amending the transition requirements would not meet the criteria set by the board in October, because it would mainly unduly disrupt the implementation that is already underway. The optionality is being effectively a cornerstone of all implementation programs that Deloitte is aware of, and effectively if you take them away now, you would create havoc, really. The other point is that the transition requirements were developed quite carefully based on prior feedback that the board received on transition approaches. And so if you go back in history, you can see that transition has been gradually developed to the place where it is now as a result of consistent and high quality and also high volume feedback from many different stakeholders. So the conclusion of the IASB staff is that because of this failure against certainly one of the criteria, there should be no amendment to IFRS 17. And for that reason, optionality should be retained. And the IASB was persuaded on a unanimous basis to accept that recommendation and not to amend IFRS 17. The next concern the IASB staff presented is on comparative information. Obviously, we know that IFRS 17 requires for the restatement, and that is also a lot of work. IFRS 17 has been written to mandate only one column of restatement. So that means that you have to restate up to the opening balance sheet of the year prior to the financial period in which IFRS 17 becomes effective. For calendar year reporting entities, and assuming that the effective date is confirmed to be the 1st of January 2022, the opening balance sheet will be the 1st of January 2021 or 31st December 2020. And then you have to restate the P&L for 2021 and the closing balance of 2021. So those are the restatements, effectively two balance sheet and one P&L. If you have a company that operates in a jurisdiction where more than one column of comparatives is required by listing rules or by companies legislation, you are not required to comply from an IFRS 17 perspective with the restatement of the extra column. You can do so, as stated in paragraph C25, on an entirely voluntary basis, but IFRS 17 will not mandate that extra column to be restated. Stakeholders have noted that this is a lot of work, even if you don't restate the extra column when you must report it. But this concern was obviously raised before the famous November 2018 decision that added 12 extra months to the timetable of IFRS 17 implementation. But it is worth then thinking through the concerns nevertheless. The other concern that stakeholders raised is that financial statements restated under IFRS 17 do not necessarily restate the full set of assets and liabilities connected with insurance contracts, and in particular, they highlighted the fact that IFRS 9 restatement approach may lead to some non-restatement of financial assets. That would distort user understanding of those entities' economic circumstances and transactions, both in prior periods and in the current period. You can also end up with accounting mismatches that may be reported in a comparative period between insurance contracts and related financial assets, with a net financial position and profit reported in the prior period that would not be comparable to the one that is reported in the current reporting period. Some of the stakeholders also observed that IFRS 9 itself has got different approaches to restating comparative information compared to IFRS 17. And so all these were material for them to indicate that a comparative decision could be restated. The staff concluded otherwise, and they agreed to recommend no amendment. They noted that the board already tentatively decided to extend the IFRS 17 timetable by 1 year, giving extra time to prepare the comparative information, so that if you like, the operational burden may have already been addressed in the eyes of the IASB staff. And also, the staff felt that the reasons which informed the board's decision to require the restatement of comparative information remain completely valid at this point. In particular, the IASB staff noted that an entity can avoid these accounting mismatches with the financial assets because it is permitted, although not required, to restate comparative information applying IFRS 9 if it is possible to do so without using hindsight, and start collecting the necessary information now would certainly lead to an application of the IFRS 9 transition requirements without the risk of hindsight being called up. The IASB staff also thought that if the board was going to permit entities not to present adjusted comparative information when they apply IFRS 17 for the first time, that would increase complexity for the users, and that would actually fail one of the criteria of the assessment basis for these concerns, causing also significant loss of useful information. Also, if you are going to permit entities not to present the adjusted comparative information when they adopt IFRS 17 for the first time, you would also increase the difficulty investors will have to cope with to understand the new set of financial statements under IFRS 17. So for all these reasons, the rationale was not to make any changes in IFRS 17, and the persuasiveness of the arguments were such that the vote was unanimous in favor of that recommendation. Then another transition topic brought back a concern number 8 on the risk mitigation option. This is actually the third time, and we know from what I already told you in the highlights that it's going to be also a fourth time in March on this topic. The point is that when this was discussed in December and in January, the IASB voted for decisions with regards to the risk mitigation option non-transitional requirements, and now in the February meeting they came back and discussed the risk mitigation option from a transition perspective. In particular, the fact that IFRS 17 requires a prospective application of this risk mitigation option from the date of initial application. So if you are a calendar year reporting entity, that is coinciding with the effective date, so the 1st of January 2022, assuming the change comes through, of course. And that is because, in the basis of the conclusions of IFRS 17, the board explained that they want to avoid the risk of hindsight. They also said that this is consistent with the way they have dealt with the transition for hedge accounting in IFRS 9, and given that the risk mitigation option is just a new form of hedge accounting under IFRS 17, they felt that that consistency must be retained. Stakeholders are concerned that perfectly valid hedging strategies that will meet the conditions for the risk mitigation option to be eligible exist prior to the adoption of IFRS 17, and not allowing the effect of those risk mitigation options to be reflected in the opening balance sheet would create distortions in the equity of entities. Imagine that rather than taking through P&L some of the changes in your VFA measurement, you retain those changes as part of the unlocking adjustment to the CSM, but you have indeed entered into derivative to hedge the risks you face as a shareholder from the financial variables affecting the VFA cash flows. Those derivatives may be in substantial fair value gain or fair value loss positions by the time you transition to IFRS 17, and that would effectively create an impact on the liability that is not reflected in the same way as the derivative is, and that could create a higher or lower equity accordingly. That will also have an impact on future periods because the CSM would then unwind. You start then applying the hedge accounting prospectively, but the opening mismatch, if you like, remains in place and still affects the profit signature in the subsequent periods. To avoid these consequences, the stakeholders that were concerned about that suggested three possible ways. So it's not that they all came from the same party, but this is the compilation that the IASB staff has put together for us. So the first one is allowing an option, another optionality in the transition regime, so allowing risk mitigation to be applied prospectively or retrospectively as a matter of choice by the individual entity. The second one is to allow insurers to choose the restatement of the risk mitigation option, but subject to a test that demonstrates that there is contemporary evidence, contemporary material to demonstrate that the IFRS 17 requirements for the risk mitigation option are present at that particular point in time, and therefore eliminating the doubt that this will be done with a hindsight. A variant to this second proposed solution was to actually just test that such contemporary evidence existed and then mandate it to all insurers, effectively eliminating the cherry picking, the choice activity, making it effectively a mandatory application for all those insurers who had the conditions in place in the past. None of these solutions appear to cut it out, and the recommendation from the staff was not to make a change to the requirements in IFRS 17. They noted that the risk adjustment, the risk mitigation option, retrospective application, would have to face the hindsight challenge because one, an entity would have to determine what amounts would have to be recognized in P&L in terms of taking them out from the restated CSM accounting. Two, applying this option retrospectively would in fact dilute the prospective nature of what this is a new form of hedge accounting, and it creates cherry-picking opportunities. And three, it does actually deal with hedge accounting transition in a completely different way to the one that banks and other entities who have already adopted IFRS 9 had to do as far as hedge accounting was concerned. The staff also noted that the use of hindsight in the retrospective application of this IFRS 17 hedge accounting would significantly reduce the value of the risk mitigation activities information from a user perspective. The application of this IFRS 17 hedge accounting reflects the decision of management in the most neutral way if you do it prospectively. And that, in the opinion of the IASB staff, is the way to make it the most useful to users. The staff also noted that if the IASB was going to allow entities to choose which relationship they would have to restate and apply the hedge accounting on 17, that would create effectively an impossibility to avoid the hindsight, and that would create effectively a scenario that would enable entities to choose the amount of the CSM on transition, and as a result of that choice, effectively direct the future profit recognition from their in-force business. Because of all these reasons, the staff recommended that the IFRS 17 requirements should be retained, and there should be no permission to restate the past. The IASB was comfortable to vote with a large majority of 13 against 1 for this recommendation. Nevertheless, requested that the IASB staff continues to carry out research and brings back this matter once more to the March board meeting. So this will be the fourth time that we discuss risk mitigation in this new round of deliberations on IFRS 17. We'll see whether this prospective solution to address the concerns can be developed. Another transition topic is concern number 25 from the list, and the treatment of the accumulated OCI on related financial assets when you apply the fair value approach. As we know, the OCI option is there for an insurer to disaggregate the insurance finance income or expense between P&L and OCI, and the insurer may be permitted on transition or required to determine the cumulative amount of OCI from insurance contracts to be set at nil under certain specified circumstances. An insurer is permitted to apply the specified modification only to the extent an entity does not have reasonable and supportable information to apply the retrospective approach as far as the OCI calculation is concerned. Stakeholders say, well, that's great from a liability perspective, but what about the assets? If I want to use the OCI solution going forward, I ended up with a nil balance in terms of accumulated OCI from insurance contracts, but then I end up with a positive or negative, potentially large balance on my accumulated OCI balance from my financial assets. Isn't it possible for us to have the reset of the asset as well? The IASB staff noted that this would potentially create a distortion on equity composition on transition for IFRS 17, and potentially also have impacts on the earnings, given that the asset OCI balance will recycle, whilst for the liability there is going to be no recycling, given it's already been set to zero. However, they recommended not to modify, not to amend IFRS 17, because permitting entities to deem the cumulative amount of OCI from the assets to be equal to nil, in the same way as is going to be done for insurance contracts, would involve an amendment to IFRS 9. And IFRS 9 is already a live standard. That will make the transition requirement more complicated than they are already, because people will have to have now a new set of transition requirements applicable only under the circumstances that are set out in IFRS 17. And that will complicate further the comparability of insurers adopting IFRS 9 and the rest of the economy adopting IFRS 9. There is also a fundamental problem that if you are resetting the OCI balance for fair value to OCI debt securities, you cannot then recycle the unrealized losses in the OCI balance through P&L when on impairment, and IFRS 9 is determined to be emerging as a result of the expected credit loss. So that creates an incompatibility between the objective of the IASB to reflect the impairment on the basis that is recycling into P&L unrealized losses reported up to that point into OCI. The staff also noted that if the IASB was going to permit entities to deem the cumulative amount of insurance finance income or expenses recognized in OCI for insurance contracts at transition to be the same amount as the cumulative amount of OCI to the related assets, that would affect the insurance finance income or expense that would be recognized in future reporting periods. And so that implicit read across of the, instead of setting it to nil, setting it to equal to assets, is also not going to be viable, unless, as already provided in paragraph C18B Roman 2, you do it because you have a direct linkage between the insurance contract liabilities and the underlying items. So in other words, the VFA assets where the underlying items are held in the balance sheet. And that is the only condition that is allowing you to use the asset OCI balance to create a liability OCI balance in your opening financial statements. So because of all these reasons, the staff felt that what the standard does is already plenty on this matter, and there should be no further amendments of IFRS 17 or IFRS 9, and the board was unanimous in supporting that. Then the topic that came after is the one that contains actually one further amendment, but let me get you there step by step, because this is a fairly lengthy topic. Is the modified retrospective approach. So first of all, the topic here is further modifications. As we know, we have the MRA and the FVA, the modified retrospective approach and the fair value approach, that are available as a choice when you reach the impracticability point and you can no longer apply the FRA, the full retrospective approach. An entity can apply the modifications under the MRA only to the extent that it does not have reasonable and supportable information to retrospectively apply IFRS 17 requirements to which that modification relates, and if it has reasonable and supportable information to apply that modification. The feedback from stakeholders is that it's difficult to interpret what is meant by reasonable and supportable information, and it is equally difficult to understand what would be reasonable and supportable information to be available without undue cost or effort. And so they were asking for clarifications and amendments of IFRS 17 in that space. The recommendation of the standard IASB staff is not to make changes. They explain that it is true that the determination of whether information is reasonable and supportable is a judgment, is a complex judgment, and requires careful consideration. But that is part of the exercise of professional judgment that comes with the compliance with IFRS 17. It is true as well that if you are allowing an entity to use each specific modification, even if the reasonable and supportable information is available, that would provide significant practical relief to those entities transitioning to IFRS 17. However, the staff concluded that if you allow an entity to ignore the ability to retrospectively apply specific requirements in 17, then you would result in an unacceptable loss of useful information. The staff also noted that an entity to apply the specified modification without having reasonable and supportable information, they would do that without the appropriate basis, and so also that idea cannot be accepted. And it is important to bear in mind that there is still an implicit hierarchy in IFRS 17. Although the MRA and the FBA are immediately available, the moment you have reached the point where the FRA is no longer supportable by reasonable information, and you have reached effectively the impracticability point, the choice is governed by an implicit hierarchy, in the sense that if you choose for a group of contracts to do the modified retrospective approach, you have to do that because you have absence of reasonable and supportable information for the FRA, and the specified modifications you're going to be applied in that particular group of insurance contracts are executed using reasonable and supportable information that is available without undue cost and effort, as a proxy to get to as close as possible to the full retrospective approach result. If these conditions are no longer in place, then the MRA cannot be used, even if you wanted to, and the only option left for the insurer in that particular group of contracts is to use the fair value approach. So the fair value approach then comes in either because of a choice to start with, or because the MRA is no longer applicable, and that is when you have absence of reasonable and supportable information for both the FRA and the MRA, and a combination of a value and modified approach that will then be in place, but you have to do that on a group by group basis. Coming then to the second concern, which was this interpretation of what is meant with the available with undue cost or effort. In paragraph C6, the IASB staff explained that modifications in the MRA have been developed with the objective of achieving the closest possible outcome to an FRA restatement, using information available without undue cost and effort. So that's the starting point. By nature, that means that the MRA data should be easier and less costly to obtain compared to what was the information that was looked for to do the FRA. But as far as the quantity of effort that you have to devote, well, is a judgment of the entity. Using the pieces of information that will be compliant for the FRA is also an important point that the IASB clarified in the meeting, must be maximized. And this term is not relevant to the application of paragraph C8 in IFRS 17. So because of all these considerations, the recommendation of the staff is to retain the requirements in IFRS 17 with regards to the MRA, in terms of how to do it, when to do the MRA, and under what conditions to do the MRA, as you see reported again on the slide. And that was supported with a unanimous vote from the board. Again, staying on the modified retrospective approach, in terms of further modifications, here the concern is that stakeholders expressed the view that the MRA is too restrictive, that is making it costly and burdensome to apply in practice, and restrictions on, in particular, on prohibiting insurers from making estimates that are necessary to apply retrospectively IFRS 17 to a number of requirements where the entity does not apply the specified modification is particularly burdensome. Some stakeholders had a view that maybe MRA could be simplified more. And they have suggested that, for example, you could allow creativity to come through. And IFRS 17 could establish a principle-based approach where you can create ad hoc modifications as long as they are consistent with the stated principle of being as close as possible to the FRA outcome. Other ideas were to make things different as far as the restatement of contracts acquired in their settlement period before transition. That's the one that actually got to an amendment. And then the other two were simplifications around cash flows that are known to have occurred, and finally removing the two different MRAs, one for insurance contracts with the direct participating features and the other one which is for the general model, and in fact it moved down to the one single MRA. So let's have a look one by one what happened. But this is the long question that the IASB staff put to the board. I just assure you that we're going to go through everything here one at a time. So let me begin with the first one. Permission to develop your own additional modifications. So this ad hoc creativity option. The objective, obviously, of the MRA is to get as close as possible to the FRA when you cannot do it properly. But the staff noted that if you are going to permit the creation of new modifications, that creates a risk that the outcome of getting closer to the FRA will not be accomplished. And for that reason, they felt that this concern could not be addressed and meet the criteria set out in October. So they recommended to the IASB not to do anything about it, and the vote was unanimous in favor of that. So that option to create modifications was rejected unanimously by the IASB. The next one is the one that actually got the amendment, the second amendment that was passed on the 7th of February. So just to remind you, acquired liabilities for incurred claims under IFRS 17 in the business combination would have a CSM balance, because that comes from the comparison between the fair value assigned to the liability acquired and the liability themselves, and that makes them a liability for remaining coverage for the buyer's perspective. So that means that from that moment, the LIC becomes an LRC. You're going to have revenue, you're going to have CSM, because it's deemed to be a stop-loss act of underwriting in the context of a business combination. However, on transition, both the MRA and the FVA do not address the classification of amounts as a liability for remaining coverage or liability for incurred claims when they arise from acquired insurance contracts. The staff noted that when they observe the practical way of managing liability for incurred claims, they notice that it's difficult to distinguish in the current environment whether these claims come from acquired business, issued business. So there is an objective difficulty to segregate at transition date past liability for incurred claims across all the different categories. For that reason, they felt that the criteria set in October could be met in full for these amendments, which means the introduction of new modifications for the MRA. And that modification will require an entity to classify these liabilities as liability for incurred claims. That means without having a CSM balance. And the second modification is actually on the fair value approach, where you have an option to decide whether you want to classify them as a LIC or not. And if not, obviously they become an LRC with a fair value on transition determining the CSM, etc., etc. But if not, I presume that means no CSM, and the LIC will be taken to the balance sheet without the CSM, just with the fulfillment cash flows and the risk adjustment, and the difference, of course, given that we are doing a fair value approach, would go to retained opening earnings. As you can see, this was approved unanimously. So that's the second amendment from this long session from the 7th of February. The next one is about cash flows that are known to have occurred. The staff noted that in IAS 8, paragraph 51, it is already clearly stated for all IFRSs that these will will make it difficult to restate the transaction the more time has gone by since that transaction occurred, in order to be restated on an IFRS, new IFRS basis. In paragraph C6 of IFRS 17, if data on actual cash flows has not been collected or has been collected but is collected on a different level than required by IFRS 17, then the entity is required to use reasonable and supportable information in order to estimate those amounts and use them for transition activity. That appears to be clear. However, the staff recommended that despite paragraph C12 should not be amended, they should write some extra comments in the basis of conclusions. So, given that the basic conclusions are part of the standard and should be subject to due process, we would expect at Deloitte that these will feature in the exposure draft, albeit without changing any of the mandatory part of IFRS 17. The approval of that was unanimous, so we'll see then in the actual text when it comes out in June what extra bit will suggest we take into account. Then the last one is on insurance contracts with direct participating features and the fact that there are two different MRAs for VFA contracts and the MRAs for the rest of the insurance contracts. The staff noted that the MRA for VFA contracts was invented really to enable entities to determine directly the CSM at transition, whereas the modifications for the non-VFA MRA are designed to go back to the initial recognition CSM and then to roll it forward to transition date. It is highly unlikely that applying the specified modifications to the non-VFA MRA to the VFA component of the population of insurance contracts would provide an outcome that is closer to the outcome that would otherwise emerge from the application of the specific MRA being designed for the VFA contracts. And so because of that analysis and conclusion, the staff recommended that the two MRAs must remain in place in IFRS 17 and there should be no spillage over. So if you have a VFA and you have reached the impracticability point, the only option for you then is either to choose fair value or if you use MRA to use the specific MRA for VFA. And if you don't have a VFA, then you got to use the other one. And that, again, was another unanimous supported recommendation by the board when vote came to be expressed. So that was the last of the points from the discussion and decisions reached on the 7th of February. Let me just conclude then the webcast by talking a little bit about next steps. So as I mentioned in the highlights and throughout the presentation, there will be some sweep issues plus the discussion on the remaining big concern, number 2, level of aggregation, in the week beginning the 11th of March when the board meets again. After that, we have a TRG, so I'm going to go to London again to discuss with my fellow TRG members some new topics. The submissions have been made, so the staff is now working on the papers, and the meeting is on the 4th of April. Technical plan has been updated and confirmation has been published that the exposure draft amending IFRS 17 will be released in the second quarter, we think, at Deloitte. That means probably in June. Also, the due process oversight board has agreed to a short comment period. That means less than 120 days. I've already given my prediction that this is going to be 60 days, but we'll see whether I'm right or whether the IASB eventually chooses 90 days instead for the exposure draft. At that point, the comment period will go through. Deloitte will be writing its own comment letter, and so would be many other stakeholders. And on resumption of the deliberation, I expect the comments to be mainly positive and the standard to be swiftly taken to ballot and publication. That would then give us an amended text of IFRS 17, restart a number of endorsement processes all over the world, and give hopefully a better base for everyone to work with in terms of completing the preparation for IFRS 17. That is the last of the points I wanted to make. As I take you to the last page of the presentation, I'll invite the recording to stop and open the floor for questions.